Assalamualaikum and a good day to you. My name is Amir Shafiq bin Rohisham from class TBA 1144E, and I will cover the first two subtopics from chapter 2, which is the introduction and the common characteristic of common stocks. Let's go. In this chapter, we will dive deeper into discussion on common stocks. Investors are drawn to common stocks because of the potential for current income in the form of dividends, capital stability, and capital gains. Every shareholder owns a portion of the company and thus has a claim to the wealth generated by the company. Common stockholders, on the other hand, have no guarantee of receiving any returns on their investment as a residual owner. Before my friends start to explain the later subtopics in investing in common stocks, let's discuss about the characteristic in common stocks. There are 4 types of characteristic in common stocks. The first one is common stock is a residual claim. Common stock is a residual claim, voting rights, limited liability, and preemptive right. In the event of bankruptcy, common stockholders have the last priority claim when assets are sold to obtain cash. Bondholders have priority, followed by preferred stockholders. Dividend income is paid to common stockholders after bondholders have preferred stockholders have been paid. Owners of stockholders have the right to vote on certain key matters affecting the company, such as the election of the board of directors, authorization to issue new shares of common stock, approval of amendments to the cooperative charter, and approvals of merger proposal. Aside from that, the owner of the shares may attend and vote in person at the annual meeting of the cooperative. Owners can appoint some as a proxy and designated party as a temporary power of attorney to vote for assignee at the annual meeting of the cooperative. Now, there are 2 types of voting right. The first one is majority meeting, and the second one is cumulative meeting. Majority meeting is simple to understand. Each share of stocks allows the stockholder 1 vote, and each position on the board of directors is voted separately. For cumulative voting, each share of stock allows the stockholder a number of votes equal to the number of directors being elected. The shareholder can then cast all his votes for a single candidate or split them among the various candidates. Now for the third characteristic in common stock is limited liability. It's quite short. The owner's liability in the case of bankruptcy is limited to the amount of their investment. And the last characteristic is preemptive right. It is a right but not an obligation of existing stockholders to purchase the new shares of common stock being sold by firms. The purpose of this right is to prevent existing stockholders from unwillingly losing their proportionate ownership position of the firm. Thank you.
Hi, Assalamualaikum. My name is Amirul Aiman bin Abdul Aziz. I am from BA 1144E, and today I will be presenting Chapter 2 Subtopic 5.0 and 6.0. Now, I will begin with the subtopic 5.0, Risk in Common Stock. Risk is defined in common stock as the likelihood that the actual return or investment will differ from what is expected. Various investment options have elements of uncertainty and expected returns. The risk-return trade-off is a connection between risk and reward in which higher risk investments should provide greater profits, and vice versa. When valuing stock, the risk-return relationship will be a fundamental notion. High risk in investing provide lucrative returns. However, if there is a loss of value that must be borne, it's also very high. There are several types of risk and there is 7 risks that I will discuss here. Number 1, business risk. The level of risk related with an investment earning and potential to pay investor the return owed to them. Number 2, financial risk. The degree of payment uncertainty caused by a company debts to equity ratio. The higher the debts to equity ratio, the higher the risk. Number 3, purchasing power risk. The possibility that fluctuating price level, inflation or deflation will have a negative impact on investment return. Inflation risk is another term for it. Number 4, market risk. The possibility that the value of a common stock will fall as a result of variable affecting the financial market overall performance. The systematic risk is another name for it. Number 5, event risk. The risk of a significant and usually sudden impact on the value of common stock as a consequence of an unexpected event. The closest example in the moment is COVID-19 outbreak that affected stock prices. Number 6, interest rate risk. The probability that interest rate fluctuations will have a negative impact on the value of a common stock. Number 7, liquidity risk. The risk of not being able to conveniently and effectively liquidate an investment such as common stock. Next, I will proceed to subtopic 6.0, transaction of common stock. An investor can trade common stock in many ways. The most important factor to consider is the profit potential from the investment method used. It is better for investors to be equipped with basic investment knowledge and rules regarding common stock transaction. For this topic, I will discuss about long purchase and short selling. Long purchase, buy low, sell high. This is a common trading strategy taken by investor. An investor buy a security at a low price and keep it in the hope that the price will rise in the future to make a profit. Securities will be sold when they reach a price higher than the purchase price. For example, buy RM3 per unit and sell in the future at 5 ringgit per unit. While short selling, sell high, buy low. Short selling is a situation where an investor sells share without owning the share. How? The shares are obtained by borrowing from a broker when the share price is at a high level. For example, RM30 for 100 lots, which is 3,000 ringgit. After that, investor will sell the share that 3,000 ringgit and then wait for the share to decline to 70 ringgit per lot, which is 1,700 ringgit. Then the investor will buy the fallen stock, which is that 1,700 ringgit, to be returned to the broker. The profit earned by the investor is 1,300 ringgit. In Malaysia, short selling is regulated under Regulated Short Selling (RSS) and Securities Borrowing and Lending (SBL) guidelines. RSS is only applicable to approved securities in the RSS list, which currently comprises 218 securities as at 29 January 2021. Furthermore, limits are also imposed to prevent excessive short selling activities. To trade, an investor must have RSS trading account, and they must either borrow the approved securities to be short sold or have confirmation of borrowing of the approved securities. Short selling is wrong on the side of Islam because it sells goods that are not owned. But if investors follow RSS guidelines, it is harus. The advantage of short selling is a chance to profit from a price decline. And the disadvantages of short selling is limited return opportunities, high risk exposure because the probability of getting the price to fall is uncertain, never earn dividend or interest, and investor must pay the interest in period of borrowing. That's all from me. Thank you.
Assalamualaikum. I am Imran Hisamuddin from TBA 144E. Now I'm going to discuss about types of common stocks and advantage and disadvantages of investing in common stocks. For common stocks, stocks that can be purchased by investors depend on their investment objective and the level of risk they can assume. First, growth stock. This type of stock has experienced and is expected to continue experiencing consistently high rates of growth and operation earnings. Second is income stock. Risk-averse investors are certified to buy these income stocks as they are safer and have high level of current income of the form of dividends. Income stocks are usually concentrated in the public utility field. Blue chips. These stocks give investors the opportunity to derive some of the advantages of both growth and income to a limited extent. The stock make profit in good and bad times and have a low risk of capital loss. Next is cyclical stock. The performance of cyclical stocks fluctuates according to fluctuation in business cycle. The example are companies that producing construction materials and also property companies. Defensive stock. This stock remains stable or even rise during economic downturns. Thus, during difficult periods of the business cycles, the price of the stock remains rather stable compared to the market average. Moving to speculative stock, these stocks are issued by companies with highly unstable earning records and very uncertain future earnings. For the last type of common stocks is tech stock. This stock represent a technology sector in the market. They include companies that produce or provide everything from computers, semiconductors, data storage, computer hardware, software, networking and also wireless communication. For example, tech stock category are Microsoft, Dell, Intel and Yahoo. Moving to advantages and disadvantages of investing in common stocks. Investors should know the pros and cons in investment. For advantage, it is easy to buy and sell stocks since the most of stocks are liquid in which they can readily be bought or sold at a fair price. The transaction costs are the modest. Stock price market and information is widely disseminated in the news and media. For disadvantages, stocks are volatile investment. The earning and general performance of stock are suitable to wide swings, so it's difficult to value common stocks. The value of investment can be drastically rise or fall depending on the market condition. Stockholders need to sacrifice in their current income. As a stockholder, you are the owner of the company, but you are the last one to get the profits from the company. This is because the extra earnings will first be distributed among the employees, suppliers, and creditors. That's all from me. Thank you.
Hi, Assalamualaikum. My name is Muhammad Hilman bin Hashim from BA 1144E. Today I will present about Chapter 2 Subtopic 7.0 and 8.0, which is margin trading and types of margin requirement. Alright, now I will start with the subtopic 7.0 margin trading. Margin trading is the use of borrowed fund to purchase securities and it magnifies returns by reducing the amount of equity that the investor must put up. There are 6 important terms that we need to know among them, where the first one are margin. Margin is the amount of equity or cash paid by investor to purchase common stock on margin. The percentage set is determined by the stock brokerage firm policy. Next is margin transaction. It is defined as a share transaction involving the use of both cash and borrowed fund. In example, a 60% margin means an investor must pay 60% of the investment value with his own money. so borrowed money is only 40%. The investor is required to pay interest on the borrowed funds. At the same time, the investor must have a margin account which can be in the form of cash or securities. The third term is actual margin. The amount of equity changes as price changes. The amount of equity will increase if the price of common stock increase and decrease if the price of common stock falls. The fourth term is the debit balance, the amount of money borrowed by an investor to buy common stock on margin. Then the fifth term is excess margin. When there are strong buying forces, the amount of equity will increase above the maintenance margin. The borrower has the option to withdraw any excess equity. Last important term is margin call. In the event of heavy selling forces, the amount of equity may fall below the maintenance margin. In this case, the borrower must provide more collateral or cash in his account to keep it at the minimum required level. Next are the advantages and disadvantages of margin trading. The first advantage is to magnify return. The lower the amount of the investor equity in the investment, the greater the rate of return the investor will enjoy when the price of the stock rises. Both allow for greater diversification of security holdings. Investor can distribute their limited capital across a greater number of investments. Disadvantages are magnifying losses if the securities price fall. Investor losses may be worse. Second disadvantage is the cost of margin loans, where the cost is a state interest rate that is determined by market rates and the amount of money borrowed. Now we turn to subtopic 8.0, types of margin requirement. There are two types of margin requirement for trading, namely initial margin and maintenance margin. Initial margin is the minimum amount of equity that must be provided by a margin investor at the same time of purchase. It is to prevent overtrading and excessive speculation. Initial margin required for stock is higher than initial margin required for corporate bonds. Investor can use the account if the margin in the account remains equal to or greater than the current initial margin requirement. If the value of the investor holding falls, so will the margin in his account. When a margin account's equity is less than the initial margin requirement, the investor will have a restrict account. The second type is margin maintenance. Maintenance margin is the percentage of the absolute minimum amount of margin equity that an investor must always maintain in the margin account. When the amount of insufficient, investor will receive a margin call, which is a notification that the equity of an account with a margin less than the maintenance level must be raised above the maintenance margin. Broker is authorized to sell investor margin holdings to bring the equity in the account up to this level. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Tarmizi bin Shafaruddin from TBA 114-4E, and I will explain about chapter 2, subtopic number 9.0 and 10.0. Subtopic 9.0 is about calculation margin. There are two main formula in this subtopic. That is to calculate margin and rate of return margin. To get the margin, value of securities must minus the debit balance and divide by value of securities. To get rate of return, market value of security at sale must plus the total current income minus the total interest minus paid on margin loan minus market value of securities at purchase and minus the transaction cost and divide by the amount of equity at purchase. Subtopic 10.0 is about stock dividend, stock split, and stock right. Stock dividend is a type of dividend payment which does not involve cash payment. It will existing shareholders in the form of stock. Stock dividend also is a replacement or supplement to cash dividend. Stock dividend are distribution of additional shares of a corporation stock that do not involve cash. If the board of directors approve 10% of stock dividend, each shareholder will get a new share for each 10 share owned. Stock dividend can increase the number of shares, move some of the company retained earnings to pay in capital, and minimize the distribution of the corporation cash to its shareholders. Stock dividend also will affect the common stock, paid in capital, and retained earnings. Next, I will explain about stock split. Stock split is a way to create more stock but at a reduced par value. Split ratio can be 2-for-1 or 3-for-1, which means stockholder will have 2 or 3 shares held earlier. For your information, stock split can affect the stock price. After the split, the price also will be decreased. For example, when it split 2-for-1, the share price also will be half of it. The motive behind split stock the motive behind stock split is to make the share look more affordable to small investors. This way, many investors get attracted to invest in the company. Stock split will affect par value and number of shares. The last one would be stock rights. Stock rights are the instrument issued by companies to their existing shareholders which provide them with the privilege to purchase new issued shares. Stock right has 3 features. First, it will give shareholders the right but no obligation to purchase new shares. Second, there will be time limit to buy the newly issued shares. Third, subscription price is lower than the public offering price of stock. Stock right can raise additional capital in a shorter time period. Many companies use it to raise additional capital. This right issue gives option to shareholders. First, subscribe the right issue. Second, ignore the right issue. And the last one is sell the rights to other investors. That's it from me. Thank you.